Yeah, it's going to be, they're going to have a grand reconciliation of asset prices. I don't know when it's going to start. I know it's not starting today. You're going to have a problem in the credit markets. You're going to have a recession, and the country is going to, devolve into chaos. And if you believe that, then, you have a chance. If you believe that, and you have a money manager that's looking out for that, is not going to just tell you, oh, just buy and hold, everything's going to be great. Stay the course, stay in your target date funds, don't sell. You could have your retirement plans wiped out.
On this episode of What the Finance Podcast, I have the pleasure of welcoming back Michael Pento, very popular guest, and very happy to have him back. He is the president and founder of Pento Portfolio Strategy. So, Michael, thanks so much for coming on the podcast today.
Good to be with you, Anthony.
Looking forward to the conversation. Lots happened since we last spoke, sort of about 6 months ago. It seems like an age, but markets keep going up. So I'm interested in hearing more about your current thoughts on what we've maybe seen and what you expect.
Yeah, well, the inflation-deflation economic cycle that I created showed that in September, we took a jump from sector 2 and 3. So sector 2 is disinflation, 3 is stasis, 3 is reflation, with a little bit of growth thrown in there too. I continue. I haven't been short the market, haven't been net short the market since 22. Haven't had any shorts except for a small high yield short since the first part of 2023. I still maintain that small, unprofitable 1.5% short in high yield, because I think that's going to be where the earthquake really begins, in the high yield bond market. But hey, listen, we're in reflation right now. Economic growth is not accelerating fast; it's not decelerating. So you just don't short that market. You just stay and be patient and realize, let's just make money while we can, as safely as possible. But you don't fall asleep here, Anthony. You can't fall asleep here, because we have the most dangerous stock market in history. If you look at the valuations, if you look at the construction of GDP, it is extremely dangerous. And you just have to pay attention.
Yeah, I'd like to hear more about sort of, going more into why I think it's dangerous. So it's more to do with the valuations. It's just, gone up so much.
Well, first,
comparing it to the past.
Yeah. So, if you look at some of my favorite valuation metrics, of course, the Buffett indicator, 207% of GDP. During Ronald Reagan's time, which was the first time we had a really great president that I was around. I'm born in 63, so I'm 61 years old. This president came in, Ronald Reagan, and rejuvenated the whole country. And he slashed the marginal rates, the highest rates. In fact, he slashed marginal rates across the board. He even cut the capital gains rate substantially. He underwent massive deregulations. But when he came to power, the first couple of years where he was in power, 81, the GDP grew at 2.5%, whoop-de-doo. And the second year, 82, it shrank by 1.8% GDP. So just because you have a president, which I'm behind, I voted for, I think he could do a lot of good things to this country, far better than Kamala Harris would have done, who was an avowed egalitarian socialist, who actually, one of her goals was, and it came out of her own mouth, is like, hey, we need to ensure not just the level playing field, which is wonderful, and for that, we want to ensure equal outcomes. So that's a redistributionist, and we don't want that in this country. This country is a meritocracy. But when Donald Trump is going to take the reins of power, the total market cap of equity is 207%, as opposed to 40%, which it was under Ronald Reagan. The national debt to GDP is 125%. It's absolutely a debt burden that's going to drag down GDP. The public and private sector debt's at a record. Ronald Reagan had 30% national debt to GDP. He had plenty of room to spend and to stimulate. We don't have that anymore. We also had a booming labor force growth. Women were entering. That was the last decade where the women came in after World War, in the 50s and 60s and 70s and the 80s. Labor force growth boomed from 63% to 67%. That was the highest we've seen in 45 years. Nothing like that has ever happened again, and it's not going to happen again. Women are already in the labor force, which is lovely. So unless you start employing household pets, you're not going to have an increase in the labor force. So it's going to be very difficult for Ronald Reagan for Donald Trump to duplicate what Reagan did, no matter how much you like the man. He just has a different set of circumstances. And if you look at things like price to sales of the S&P, it's at a record high. We have a huge bubble in real estate, such that commercial real estate and regular residential, it's just not moving. There's no transactions. The transactions have dried up because people can't afford to buy a new home. When you add taxes and insurance to the equation, it's just unaffordable. So there's a lot of challenges that aren't going to go away just because you elected Donald Trump, unfortunately. And we do have this reconciliation of, I would call it a grand reconciliation of asset prices. Asset prices don't belong at 208 or 7-8% of GDP. They just don't belong there. They belong like 80 to 100% just to be around fair value of GDP. So you can make the argument, well, GDP is going to skyrocket. I just told you why it's not going to skyrocket. It really can't. And I'm not even telling you that I haven't even discussed the fact that Reagan came in and he didn't impose massive tariffs and deportations either, which is a threat that Donald Trump is threatened to do, which would be a depressant to growth. Half of GDP growth comes from productivity, and the other half comes from labor force growth. Well, you're going to eliminate a lot of people that are in the workforce if you deport 10 million people. So, yeah, it's going to be we're going to have a grand reconciliation of asset prices. I don't know when it's going to start. I know it's not starting today. You're going to have a problem in the credit markets. You're going to have a recession, and the country is going to, devolve into chaos. And if you believe that, then you have a chance. If you believe that, and you have a money manager that's looking out for that is not going to just tell you, oh, just buy and hold, everything's going to be great. Stay the course, stay in your target date funds, don't sell. You could have your retirement plans wiped out.
Okay, yeah. So that's sort of saying that you expect, at least 50% sort of drop in the market at some point. Obviously, you're saying it's not now, but in the future that could happen.
I think it's very possible to happen. Yes, could be more than that. Unless you make an argument, unless you're going to make the argument that GDP growth is going to skyrocket in double digits for many years, and I just can't come up with it. I just can't come up with that scenario. In fact, it's more likely to have a recession, and then the recession comes and deficits go from $2 trillion per annum to $6 trillion. And then you have a problem in credit markets, and you could have GDP crash and revenue crash. That's more likely to happen.
Okay, so how does the US get out of this? Do you look at any other examples in the past where economies with such large debts are able to recover? I guess it's all the currency. Yeah,
I give you two examples. We could be Japan. That would be the best case scenario, where they have a chronic disinflation. GDP growth in dollar terms hasn't gone anywhere in 40 years. So maybe that's the best case scenario. The stock market hasn't gone anywhere in 35 years. And the Bank of Japan owns the entire JGB market, Japanese government bond market. That could be where we're headed. And the other alternative is we could go the way of Zimbabwe or Argentina or Hungary in post-World War II, where we hyperinflate into oblivion. I don't know. I'm not sure if we won't have both at different times. But that's when a country gets this much in debt and has this degree of asset bubbles, it might not be the intensity of the Hungarian. The dollar may not undergo the same fate as the Hungarian pengo. Maybe we'll have thousands and thousands % of inflation, but intractable stagflation for a very long time, double digits, is very likely and very destructive.
Yeah, so that's the only way. Those are the two options that you see. Is there a potential that I guess Elon Musk could come in and cut costs or you don't think that will reduce deficit enough to put on the right path?
What is he going to cut? Is he going to cut Social Security. You're not going to get that. I mean, the Republicans don't have that kind of majority in either house. I don't think Donald Trump wants to touch Social Security. Well, if you can't touch Social Security, Medicare, Medicaid, and defense and the interest on the debt, what are you going to cut? I mean, I don't know. You might be cut, a few billion dollars here and there. But what are you going to, what really are you going to cut? And if those kind of cuts, what would that do to the economy? I don't think, you see, listen, there's no free lunch. I don't think there's any easy get out of jail free card here. No easy pass. There's, for every action, it's one of the law of thermodynamics. For every action, there's an equal and opposite reaction, and there's going to be a negative reaction of having decades of artificially produced negative real interest rates and a decade of nominal rates that were close to zero. That what you get is massive asset bubbles and a massive increase in debt, and those have to be reconciled, and it's painful when it happens. And I don't know any way out of it. Maybe I'm just not smart enough to understand it. Maybe it's something that I never thought of. Elon Musk is smarter than me. He can land a rocket ship on a platform. I can't do that. But maybe he's come up with something that I don't know of, and history has never witnessed. But I doubt it.
Yeah, it seems very unlikely. So then, if you look at the Fed, they've sort of been taking actions. They've been cutting interest rates. Maybe that's been, making the issues worse because money is becoming cheaper. Do you think they made the wrong decision to cut so soon, or do you think inflation could be an issue moving forward? What are your thoughts on
that? I'll tell you this, Sue. So I was listening 3 weeks ago to Bloomberg interview with Susan Collins from. It was a Bloomberg interview. Susan Collins, president of the Boston Fed, lovely woman, very intelligent, beautiful woman. Just say anything about her personally, but these people that are in charge of the purchasing power of your money. This is what she said. She said, and the interviewer said, I think it was Mike McKee, said, what do you think about inflation here? I mean, where are you going with interest rates? And she said that inflation, X food, X shelter, and X energy is pretty much back to the 2% level. So we're good on continuing to reduce the level of the Fed funds rate. I mean, these are the people that we have in charge of preserving our standard of living and protecting the purchasing power of our retirement funds and our dollar, our currency. These are the people. I mean, that came out of her. So it's not, what she should have said is, I know inflation is way higher than our target, which is an asinine 2%, which our target should be 0. And I know it's going in the wrong direction because the core rate of inflation is rising, but that's bad enough. What's really, really bad is the level of prices has destroyed the middle class, and we need to get prices down, maybe slowly, but the level of prices, in other words, we need deflation to restore the consumer's purchasing power. We're going to try to do it as fast as we can and as safely as we can. But there's going to be pain in Wall Street and in the real estate market, and maybe some banks will have problems too. But in the long run, that's what we need to do. She didn't say that. She said, hey, inflation, if you count everything that's massively important to people who aren't spirits and who don't live as cave people, if you don't count that, then we're back to around 2%. So hey, let's cut interest rates and see if we can get inflation going a little higher, a little faster. That's my, I'll leave you with that. That's what I mean. This is the most odious institution ever created by a republic, a free republic. What Elon Musk could do is, and he's talked about, I haven't heard his exact idea, but he's talked about like maybe creating a model for the Fed so we don't need all these people and all these, hundreds of economists and whatever doctors at the Federal Reserve, doctor of an economist. Listen, here's what you need to do. Let's look at base money supply, high-powered money. We need to have that fettered and controlled. Let's make that grow commensurate with potential GDP growth, which is 2%. And then we can link that back to gold, because mine supply of gold is about 1% per annum, 1.5% per annum. So the base money supply never grows like by $4.5 trillion in a matter of a few months, like it did in the COVID era. And then we let the price of money be a function of supply and demand. So the supply of savings versus the demand for money. Oh, wow. What a novel idea. Wow. So we won't have to parse the words of Jerome Powell like we're reading scripture. And, this man is looking at, I'm not just blaming him, it's the whole cabal there. He looks at data. He's data dependent, right? He's data dependent. He's looking at data that's stayed, it's old. So he's looking at lagging data that is faulty, that gets revised by like massive revisions. And I think my model is a little better than his. It takes out all of the human error.
Yeah, and then they encourage in the UK and other economies to sort of do forward guidance as if their predictions are close to where the markets actually go, or where their policy actually goes. It's ridiculous.
Anthony, they don't know what causes inflation, or they claim to. It's a vibrant labor market. So they don't know what the true cause of inflation, which is printing too much money, and it's the destruction of the market's belief in the purchasing power of a currency, of a fiat currency. That's what inflation is, and it's usually caused by a central bank. And then not only do they not know what causes it, they have no clue how to measure it. Kevin Warsh was on CNBC, did a marvelous job of explaining this, and he's a former Federal Reserve guy. What are we looking at here? Are we looking at CPI? Are we looking at core CPI? Are we looking at PCE? Are we looking at core PCE? Are we looking at super core? Now we're looking at the rate of inflation X shelter, food, and energy, according to Susan Campbell. Really? Is that what we're doing? No, I mean, I have zero confidence in these people getting anything right. Anything. If they get something right, it's purely by accident and purely coincidental. Then it won't last long.
Yeah. Lucky inflation isn't on anything important. It's just the things that we need, that everyone needs.
Yeah, I mean, if you don't look at shelter and energy and food, why? And I couldn't. I said, I was listening, and I said, "Is that real? Did that really come out of her mouth? Is that who we have hired? One of the people hired on the Federal Open Market Committee to make decisions about the cost of money and the quantity of high-powered money? This is the person who, the middle class has been eviscerated. They can't afford to buy a house. They can't afford insurance. They can't afford to pay their taxes. They can't afford a new car. They can't buy a new house. The price levels are through the roof of everything, including education, medical insurance, car insurance, homeowners insurance, rent. And this person says, hey, X shelter and X energy and X food, you're good. So let's lower the interest rate a little more.
So sort of from what you're saying, no matter what they do, it's going to be, they're not looking at the right things.
Even if they were looking at the right things, they have no clue what causes. I mean, like I said, I would love Jerome Powell to get up and say, listen, obviously I don't know what I'm doing. I was wrong about inflation being transitory. I panicked to cut rates in September of this year by 50 basis points. I cut them again and in November. I'm going to cut them again in December. I'm just cutting them because, hey, I don't think that the Treasury can really afford to pay $1 trillion in interest payments. So let's get the T-bill rate down as much as possible. And let's hope the stock market doesn't go ballistic. So maybe it'd be better off if I just step down. We close the doors to the Eccles building, make it a museum, a disgraceful museum. And then we'll just make base money supply grow by 2%, link it to gold, and let the market decide what interest rates are, and we're good. And if an institution fails, sayonara. They took too much risk.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, well, don't see that happening. He's been talking positively today about Bitcoin and other things. So it's seems like the animal spirits are gonna continue.
Yep.
So you mentioned the 3 bubbles. So there's the real estate market, the stock market, I believe, and then sort of what else do you think is
the credit bubble?
Credit bubble.
We had, like I said, we had 10 of the last 14 years, interest rates in real terms were negative. That's unprecedented in history. And what happens when borrowing costs in real terms are negative, and in nominal terms they're pretty much free? Ooh, people borrow a lot of money. So then we have things like private credit, which was something that didn't even exist in the global financial crisis. Now it's $2 trillion worth of businesses that they can't get a bank loan. They're highly leveraged businesses. They can't get a loan from a bank. They can't float debt in the corporate bond market. So they go and borrow money from a private credit dealer. And since it's private, there's no market for it. And when a recession comes, people are gonna be like, "Hey, that $100,000 I gave you, can I have that back? What's it worth? I don't know. That business went under. So I mean, these are things that are gonna happen. Total non-financial debt is now 260% of GDP. That's a record high. The asset bubbles. We have a triumvirate of bubbles in real estate, equities, and in credit, and that has never been the case before, because we've never deformed the cost of money and its supply like we've had before. So there are consequences, and they're going to be dire. Now, having said all that, people say, "Oh, Mr. Pento, you're a perma bear." Well, no, I actually run money for a living, and we have a nice solid year of returns here. I wouldn't have very good returns at all. They'd be negative if I didn't. If I was just like, "Hey, let's just short the market and sit in cash," and that wouldn't have a very good relationship here. I have an inflation deflation economic cycle portfolio. It monitors the second derivative of inflation and growth and tries to keep me a nervous bull, nervously long in the right sectors until the time is right to sprint for the nearest emergency exit, which I think is a very narrow door.
Yeah, definitely. So I was going to ask that. So how do you position? So you said, which sectors do you think are benefiting currently? Which sectors are not? And I understand this is a very fluid thing, so things can change on a dime. But
right now we're in sector 4, which is reflation. So you don't short the market in reflation. Growth is not booming higher, but it's slightly accelerating. So you go long higher beta stocks, cyclical stocks, quality growth stocks. You don't own any long duration bonds. And you change when that changes. You watch it every day. I mean, when the copper gold ratio begins to plunge, and I see break-even spreads plunge, and when I see financial conditions tighten and credit spreads blow out to the points where I have triggers in my model, I will change. Until then, I'm not going to.
Okay, that makes sense. So, and what is the next stage? You said the reinflation stage now. What sort of comes next? Is that the collapse or?
I think we very well easily can go back into sector first 3 and then maybe 2 or even 1, which is a recession and deflation. That's still a real possibility, but it's not an imminent concern of mine. Predicting what's going to happen in 2000, late 25 or 26 is nonsense. Because what's happening now in the next 3 months is how I manage money. What do I believe is going to happen now in the next few months? And it's sector 4 right now. So that's where I'm allocated.
Yeah, that makes a lot of sense. So, do you think there's a way to reverse the current trend and for the middle class to be saved or even just to, recreated? Or, you've talked a lot about, Japanification of the economy, potential hyperinflation, which, both are not very good solutions. Can you turn this around?
Yeah, I'm sure we will after the carnage occurs. After if you take, so the home price to income ratio is at a record high. It should be around 3, and it's right now in like 5.6 or something like that. Well, when home prices go down, unless you're going to make an argument that incomes are going to surge from here, I don't like for all the things I mentioned. I don't think it's going to happen. That's very damaging to banks, and it's very damaging to the net worth of a lot of people. Many of them have multiple homes. That's very painful. But that's mean reversion, and I believe in reversion to the mean. If the stock market gets back to a level that's 100% of GDP, market cap to GDP, that's a 50, 55, 60% crash. How's that going to do? What effect is that going to have on the economy? It's not going to be beneficial. It's not going to be beneficial for investment banks. So the Fed's going to have to step in. They're going to have to step in, and I don't know when they step in, but at some point in that process, in order to avert a depression on steroids, they'll step in and they'll buy trillions and trillions of dollars of government debt like they've done before, but there won't be any end to it immediately, for sure. They'll have to do it, and they'll just take those bonds out of the public's domain, so out of the realm of public price discovery. They'll warehouse them in cold storage on their balance sheet. So you're talking about the recipe for another. This is what we were condemned to do. We're going to go from recession, depression to stagflation, and back and forth. Because the economy isn't real. It's not a market-based economy any longer. It's based upon the whims of people like Janet Yellen, Jerome Powell, and the carnival barkers in DC.
Yeah, well, probably similar to us as investors, they have a very narrow path that they have to try and go. It's not even to fix the issues, it's just to stop it from falling apart around them. So I think I'm assuming that's what they're doing.
Yep.
Michael, thanks so much for coming on the podcast today. My last question is, what is one message you want people to take away from our conversation?
Yeah, if you are a buy and hold 60-40, set it and forget it portfolio holder and holder of multiple houses, don't go to sleep on your money. Be vigilant. Be ready to cash out when things turn sour, because I know that the Federal Reserve has been ready and willing to inculcate to people over the decades that, hey, if things go bad, we'll just print our way out of it. Well, if things go bad because of inflation and debt, if those are the salient issues, and how do you print yourself out of that? How do you borrow and print yourself out of that? So the bond market could go absolutely haywire. And I would just think that this is, I would like to impress upon you, this is not, your father's or grandfather's stock market. Things are very different. No one would have ever believed pre the global financial crisis that the Federal Reserve would print, $8 trillion, but they did. And things that you never thought would happen in a free market economy are happening. And if prices don't always bounce back. It's like from 1929 to the 50s for the stock market to recover here from the Great Depression. And in Japan, they're still waiting to get back to even from 1989 in nominal terms. And the Shanghai Composite is down significantly, I think 45% or so, since 2007. So things don't always bounce right back. And for people who are close to retirement, they might not have decades. They don't have decades to make a comeback. So you don't have to be a passively managed pigeon. You can be more active.
Great point. Yeah, if you're retiring and credit, property, and real estate, and equities go down, that's a pretty bad situation.
Yeah, I mean, everything seems to go to a correlation of one when we have a recession. So I can't see housing booming if the stock market crashes and the Fed cuts rates, then you'll have some monkey come on the mainstream financial media and say, "Oh, lower rates are great for housing," even though the unemployment rate is skyrocketing. It's a triumvirate of bubbles. They will tend to pop concurrently. All right.
Makes sense. Yep. Great, Michael. Thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
So the website is pentoport.com, and you could find me there. I publish a weekly podcast called the Midweek Reality Check, and it's $50 a year with a 4-week free trial. And I give you my high-level view of what's going on. And if you have $100,000 to invest and you are a U.S. citizen, I will directly manage your money in the inflation, deflation, economic cycle portfolio.
Perfect. Great. Thanks so much. I'll put it in that description, but thanks again for your time.
Thank you, Anthony.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.